It's time to bring in our next guest. It's going to be Luke Gromen, founder and president at FFTT. Welcome back to the show, Luke.
Thanks for having me back. Thanks for having me back on, Tom. How are you today?
I'm doing good. The market's a little bit of a rebound here today, but we've had a lot of volatility since the start of the year. What's your take? We talk about the dollar. We talk about yields with you quite often, Luke, and we're hitting some levels we haven't seen for a while.
Yeah, I think it's all about the dollar and yields right now, and we're getting back into, with the dollar where it is, this regime that we saw in the third quarter of 2022 and third quarter of 2023 in markets where it's dollar up, gold flat to up, and everything else down. And that, I think, is going to continue until the dollar's weakened. We've seen oil join the dollar and gold moving higher to start the year. That doesn't really help, unfortunately. Essentially, there's no difference between a country who's short dollars and a country who's short oil, since most oil is still priced in dollars. And so the higher the dollar goes, the higher oil goes, the more selling pressure there's going to be on 10-year treasuries. The higher 10-year treasury yields are going to go. You can see this very tight correlation over the last several years between the dollar and 10-year yields. Excuse me. And ultimately, as you noted, we're starting now to get the 10-year yields that are problematic for multiples on stocks and for stock valuations and stock prices.
When you look at that, the impact of those rising yields to the equity markets at this point, Luke, because it seems like everybody's on the side that, hey, we're going to continue this bull rally that we've seen over the last couple of years. Maybe now we're not going to get those 20% gains that we've had over the last couple of years. But people are still pretty optimistic on, the path for equities at this point. But when you've got a couple asset classes like rising dollar and rising yields, and maybe this is sustainable, that's just going to cause headwinds, right?
I'm still bullish on the year, but they will cause headwinds. And so over the next 2 to 3 months, particularly given policy uncertainty in Washington, I think this chop we've seen for the last, call it, month or month plus, is probably going to continue with a bend to the downside on stocks and on risk assets, and a bend to the upside on yields, until some sort of bigger liquidity injection or bigger, practically speaking, some sort of bigger liquidity injection will probably require some sort of bigger, I don't want to say crisis because that's too strong, but bigger problem, whether that be a series of sloppy treasury auctions, whether that is, dysfunction in the treasury market, whether that is, a stock decline enough where it begins to show up in economic data, those types of things.
One of the things that, I've been watching, Luke, is the fact that, even though we've had a pullback in equities over the last couple of weeks, it doesn't seem like people are using treasuries as a safety play at this point. You mentioned the impact of the higher dollar pushing people away from treasuries at this point. But do you see that ever turning in the near term where, hey, at some point with the equity market still at elevated valuations at this point, that a push into treasuries might be warranted at some point, because it just seems like nobody wants to be involved in, the treasury market at this point?
No, it's really more mechanical than desire, in my opinion, in terms of these treasury moves, which is to say, foreigners, by virtue of the trading system we've had in place over the last 30, 40 years, they own $57 trillion in dollar assets, $22 trillion net, and $8.5 trillion of that are treasuries. And on the other hand, they have borrowed, thanks to Fed's zero interest rate policy post-GFC, they've borrowed $13 trillion in dollar-denominated debt, they being foreigners in aggregate. And so as the dollar gets too strong, foreigners have to sell dollar assets to service dollar debt. And what they sell, practically speaking, is what they can, not necessarily what they want to, which is treasuries. And so that's why we've all of a sudden had these correlations flip, where higher dollar, weaker risk means higher yields. And so I don't think there's going to be a whole lot that changes that anytime soon without a significant decrease in U.S. debt to GDP, or devaluation in the dollar. And problematically, that is kind of symptomatic or points to the problem, the corner the Fed has painted themselves into post-2022 by tightening as aggressively as they did, which was if the Fed hikes to fight inflation and the dollar rises, Treasury yields the long end's going to run away from them. And if the Fed cuts to address that into inflation that is presently bottoming and in some cases reaccelerating, the long end's going to run away from them. So from a mechanical standpoint of just flows of stronger dollar, foreigners need to address dollar borrowings by raising dollars, by selling treasuries. And then this dynamic of where we are in the inflation cycle, the Fed's really painted themselves into a corner. And so for me, long-term treasuries are kind of a blood sport trading vehicle. Have fun if you want to, but I don't think we're going to see flocks into long-term treasuries in any real way, barring something, catastrophic. We get another pandemic or something crazy like that, or a war, then yeah, maybe for a cup of coffee. But even then, again, everyone's going to be short dollars on their dollar debt. Yeah. They're going to need to raise dollars somewhere, and they're going to be selling treasuries to get it. So there's this flow aspect that I think has increasingly dominated the flight to safety aspect that has really been the story for most of my career up until a few years ago.
Now, when you see this, everybody's talking about 5% for the 10-year Treasury yield. Do you see that taking place? And what kind of impact is that going to have on these corporations that are going to start reporting earnings starting tomorrow with this dollar near 110 and Treasury yields near 4.8% and maybe on a tractor beam to 5%? What type of impact is that going to have on equities, at least in the near term?
For me, I think it's mostly from an earnings multiple standpoint. In other words, I think people will get more concerned with equities and the multiple they'll put on them, given a 5% Treasury yield and a stronger dollar. I do think it'd be a slight headwind to earnings, probably more from hey, if the dollar stays this high, there'll be translational impacts on earnings that we need to haircut by X. But I don't think it'd be huge at this point. I think the bigger impact is ultimately around the federal government and the Treasury market, this is where I think the Fed screwed up this cycle, is that they didn't let inflation run higher for longer in 2022 to get debt to GDP down to sustainable levels, which I think is in the 70 to 80% of GDP, down from 125% today. Had the Fed done that, then yes, if yields are at 5% on the 10-year, if yields are at 5.5%, 6%, maybe it triggers a recession, maybe it slows it, but it never would credibly threaten the solvency of the United States government itself with a debt spiral. And because the Fed did not let inflation run higher for longer in 22 and 23 to get debt to GDP down to a sustainable level, now 5%, 5.25%, 5.5%, this threatens to tip the United States into a debt spiral, because when you have debt to GDP of 125%, you have 7% of GDP deficits. Once you have your interest rate go above the growth of your economy, nominal growth, you start going into a debt spiral. And for the U.S., it'll look like higher dollar, higher yields, higher interest, higher deficit, higher issuance, higher yields, higher dollar. We started to see that unfold in the third quarter of 23, third quarter of 22. That's a really ugly environment for pretty much everything but the dollar and gold as well. Other than that, nothing much is going to do well. And so to me, that's really the important sort of I agree there's a tractor beam at 5, and ultimately turbocharging that tractor beam is the dollar. And foreign policy of the United States is turbocharging the dollar, which is turbocharging the tractor beam to 5. So we're in a very tenuous, I think we're in a much more tenuous situation than a lot of market participants realize in terms of the next 2 to 3 months. We don't have great visibility on policy. We can see what the dollar is doing. We can see what 10-year yields are doing. And we are getting frighteningly close to rates moving above the growth rate of our economy. And once that happens, things will move very nonlinearly, very fast in that sort of debt spiral unpleasantry that I rolled through earlier.
Boy, I hope that doesn't happen, Luke. It's going to throw your equities higher, theme out the window here if we see more of that. But got the new administration coming in. Hopefully things get fixed on that side of it. All right, great discussion, Luke. Have a great day.
Thank you. You too, Tom.
All right, that's Luke Gromen, founder and president at FFTT. Follow him on Twitter. He puts out some good stuff.